Producer Price Index (PPI) refers to U.S. wholesale prices. The Producer Price Index exceeded expectations in February. The February PPI data concludes the trend of the February Consumer Price Index (CPI) announced on March 12. The trend of slowing inflation. Disinflation appears to be stagnating or, in fact, reversing back to inflation. As data like this continues to emerge, it becomes increasingly difficult for the Fed to justify preemptive interest rate cuts. The rate of increase in consumer price in high-income countries is also increasing at the rate of unprecedented in 40 years. The same goes for interest rates. Currently, concerns are growing that the era of long-term low interest rates and low inflation is over. Now, most investors are once again concerned that they may have unestimated inflation. Over the past 20 years, the Bank of International Settlement (BIS) has shown a different perspective from global financial institutions and major country central banks. In particular, there have been warnings about the risks of ultra-loose monetary policy, high public debt, and financial vulnerability. BIS again announced a meaningful analysis of the macroeconomic environment through each 2023 annual report. February PPI rose 0.6% in February compared to the previous month. It was twice as high as Wall Street's forecast of 0.3%. Compared to the previous year, it rose 1.6%, the highest rate of increase in 6 months since August 2023. It exceeded the forecast 1.1%, and the increase was larger than the previous month's 1%. Core PPI, excluding food and energy, rose 2.8% compared to the previous year, an increase greater than 2.7% in January. The U.S. retail sales announced by the U.S. Department of Commerce fell short of expectations, but it was not enough to allay concern about inflation. U.S. retail sales rose 0.6% in February compared to the previous month. Consumption, which was active at the end of last year, fell in January and then seemed to revive in February, but it falls short of the 0.8% increase that Wall Street had predicted. Due to inflation concerns, government bonds yields also jumped, adding to the burden on the stock market. The 2-year interest rate, which reacts sensitively to expectations of changes in the base interest rate, was traded at 4.689%, up 6.9 BP. 1 BP equal 0.01% point. The yield on 10-year government bonds rose 10.6 BP to 4.297%. By stock, NVIDIA's stock price fell 3.24%. NVIDIA's stock price fell in 4 out of the last 5 trading days. Virtual assets also stumbled due to the price indicators that exceeded market expectations. Bitcoin is trading at $70,655, down 3.4% from 24 hours ago. Bitcoin once fell to the $69,400 range and even gave up the $70,000 range. Ether fell 4.1% to $3,835. In the 1970s, a situation of mixed inflationary pressure and fiscal vulnerability did not exist. Therefore, the last mile for BIS to return to the 2% inflation target may be the most difficult. In addition to economic logic, the financial hurdle can be difficult in a political context as well. Populism, mass psychology was not a factor in BIS, but it is now having an important influence. BIS says the unexpected monetary and fiscal stimulus measures introduced during the COVID-19 pandemic were justified as a kind of insurance, but they were excessive and extensive and having long-term repercussions. Meanwhile, as low interest rates continue for a long time, financial stability risks worsened. It is unknown whether the current situation is a process of a long-term change or a temporary phenomenon. This depends on whether the high inflation is simply due to supply chain shocks. Now we need to pay attention to whether the era of ultra-low real interest rates is coming to an end. If real interest rates remain accommodative, the current situation is temporary. Otherwise, there will be significant economic pressure as current debt level become unsustainable at high real interest rates. BIS should be more relaxed in responding to low inflation in each country. However, in this case, there is a greater possibility that monetary policy will become ineffective in the event of a severe economic downturn. BIS also argues that macroeconomic stability is not necessarily important. However, long-term economic slowdown and high inflation are crises that cannot be tolerated. In addition, a stable macroeconomic environment makes corporate decision-making easier and is at least conducive to economic growth.